Now that takes us to our next presentation, which is from Thinktank, and it's entitled The Rise of the Non-Bank Sector and Its Value to Investors and Borrowers. Now again, LRBAs or limited recourse borrowing arrangements do attract a lot of attention in the media and a lot of discussion in the sector about the pros and cons and how these strategies work and the risks involved with them as well. Now, unfortunately, for people wanting to invest in via an LRBA, we're seeing the funding of those shrinking in a lot of ways. The major banks shying away from this right now, which means other avenues are accessible for SMSF trustees to use this as a strategy. And Lauren Ryan from Thinktank, who is a business development manager for investments for Thinktank Commercial Property Finance, is going to take us through this subject. So I will now hand over to Lauren. So take it away. Please welcome her and take it away. Thanks, Lauren.
Good morning, everyone, and welcome to the SMSF Trustee Empowerment Day. Thank you for joining us. My name is Lauren Ryan, and today I'll be presenting on the reasons why borrowers and investors turn to non-bank financial institutions for their borrowing and investing needs. Before we get started, just a quick disclaimer that everything we discuss today is general advice. For any personal advice, please speak to your financial advisor or professional in regards to your personal circumstances. I'd like to start with a quick introduction to Thinktank for those of you who aren't familiar with us or who haven't heard me present before. We've been providing lending solutions to SMEs, SMSFs and self-employed borrowers since 2006. All of our founders and senior executives have been with the business since the beginning and have had a great deal of experience in lending and wealth management. In 2020, November 2020, Thinktank completed the largest commercial mortgage-backed securitization transaction ever in Australia of $600 million, which included our first institutional European investor. And a few weeks ago, we completed our first ever residential mortgage-backed securitization, which was upgraded to $500 million. So we're still seeing a lot of activity in the institutional markets for domestic and international investors looking to secure the kinds of assets and borrowers that we lend to here at Thinktank. So today we'll be discussing why borrowers and brokers turn to the non-banks for their lending needs and how institutional investors and private investors such as yourselves can gain access to the income derived from commercial and residential-backed mortgages to meet your income and capital protection goals. So in the presentation, we'll cover the three topics: the ways in which non-banks serve their customers, an example of a top-up and a GST loan. These are the kinds of loans we fund in our high yield trust, and we'll go through an example of each, and how institutional and private investors derive their income from Thinktank's mortgage trusts. So over the last decade, we've seen an increasing percentage of borrowers turning to the non-banks to accommodate their lending needs. Many of Thinktank's borrowers are self-employed, small to medium-sized businesses or SMSFs. There are additional complexities in assessing these kinds of deals, which are poorly supported within the traditional banking framework, enter the non-banks such as Thinktank. The major domestic ADIs in Australia have spent a large amount of resources over the years to build automated credit underwriting programs, predominantly for residential mortgages. The less a human credit underwriting officer has to intervene on a loan application, the lower the cost of that mortgage. And over the years, we've seen the major domestic ADIs reducing the amount of credit officers as they refine and improve their automated underwriting programs. For borrowers and loans that fit into these automated programs, the cost of originating that particular loan is lower for the ADI, and thus they're able to offer cost-effective mortgages. And every time a human is required to intervene in the underwriting process, that specific loan becomes more expensive. And let's call this intervention a touch point. The fewer the touch points, the less expensive the loan for the ADI and the lower the rate available to the borrower. Thinktank's borrowers on average have 3 touch points as part of the underwriting process, and as such wouldn't necessarily be appropriate for a domestic ADI. Turning to commercial and SMSF mortgage products, over the years, the major domestic ADIs have moved away from offering SMSF products to borrowers, which no doubt many of you have experienced personally. And part of that reason is for the reason described above. It's a bit more complex and requires more human intervention, which was going against the automated credit programs that they were spending resources to build. Managing and preserving cash flow is important to SMEs, self-employed and SMSF borrowers, as it is for PAYG borrowers, but probably even more so for self-employed and SMSF borrowers. And Thinktank structures its loan products with this cash flow front of mind. Our longer loan term facilities equate to lower monthly loan repayments for all customers, and lower loan repayments allows cash flow savings for borrowers that can be used for capital expenditure and business growth. We've also seen over the last 15 years that this approach to cash flow has an influence on lower levels of arrears as repayments are quite manageable. All of Thinktank's borrowers are bank quality clients that are seeking the commitment of a loan term of 25 to 30 years without the worry of regular revaluations or their WALEs coming into play, and WALEs are weighted average lease expiries. So why do borrowers turn to non-banks such as Thinktank? Their products are focused on preserving cash flow, and this is done through longer loan terms, no regular revaluations, no regular covenant reporting requirements, no ongoing fees and charges, high quality service and response times. And we saw this probably highlighted last year and in some cases still this year, with some of the major ADIs having some of their processing teams offshore as opposed to having it all in-house in Australia. And we offer products to borrowers that the banks have started pulling away from, such as SMSF lending, which has demonstrated to be the best performing loan asset since being introduced for us, including during the past COVID-driven economic events. Sorry, got a bit ahead of myself there. There we go. Many of you will be aware that Thinktank has 2 investment trusts open and available for private high net wealth investors such as yourselves. The Income Trust is a first mortgage trust, which is a product I'm sure you're all familiar with, so I won't go into further detail. The High Yield Trust is a second mortgage trust, whereby Thinktank holds the first mortgage funded via one of our institutionally funded warehouses. To explain to you all today how Thinktank offers a value add to borrowers, and as such why they choose to take their business to the non-bank sector, I'm going to explain 2 real life examples of loans funded from our High Yield Trust. The first scenario is a GST loan from one of our SMSF borrowers. Residential properties within an SMSF need to have a third-party arm's length tenant to meet the necessary compliance requirements. Commercial properties, however, are able to be occupied by an associated party of the SMSF. This is an attractive strategy used by self-employed borrowers to own their business premises in their SMSF and lease their property back to their business at market rates. When purchasing a vacant commercial property, the SMSF is required to meet 10% GST at settlement. Once it is proved the company trustee has moved into the premises, the ATO will refund that GST amount. Now, this GST bill can be met a number of ways, which you may be aware of, from cash reserves in the fund to a correctly documented member's loan or additional non-concessional contributions. However, this GST bill can also be met from a secondary LRBA loan in the form of a GST loan. There are 2 main reasons why a Thinktank GST loan is attractive for borrowers. There are 3 main reasons, sorry. The GST loan is correctly documented and secured by a second registered mortgage over the property and funds the GST component. When the GST refund is received, these funds must remain in the SMSF, which they are then used to repay the GST loan to Thinktank. Another reason, if a beneficiary of the SMSF has sufficient funds and has headroom under the non-concessional contribution rules to make an additional contribution, then they could meet this GST payment. However, the 10% GST is then trapped in the SMSF and cannot be released back to the beneficiary. Some customers would prefer preserving that capital outside their SMSF rather than making a payment to the SMSF. Thus, a loan for the GST amount is quite attractive. And the third, where the maximum non-concessional contribution amount has been met by the borrower's intended equity for the purchase, then they would be unable to contribute further funds for the GST owed. This is where a GST loan assists with that purchase, the desired asset in full compliance with the SMSF contribution rules. Those are a few live examples of why borrowers use the SMSF GST loan that Thinktank has on offer. So let's look at a recently approved and settled SMSF GST loan. Thinktank was presented with a borrower who has owned and operated their own professional health business for the last 13 years and is looking to purchase an owner-occupied office in St Leonards, which is in Sydney. The purchase price of this property is $705,000, and the borrower is requesting a 75% loan to value ratio, which equates to a loan amount of $528,750 at a rate of 4.99% per annum. The rental income that the business will pay to the SMSF is proposed at $54,000 a year, and the borrower will continue to contribute the maximum 25,000 non-concessional contributions each year, which has been increased to 27.5, I believe, as of the 1st of July 2021. This borrower wishes to borrow the 10% GST from Thinktank, which would take the complete loan to value ratio to 85%. The GST paid to the ATO will be refunded to the SMSF once the borrower completes his quarterly business activity statement and proves the corporate trustee of the SMSF, which is his mental health business, is occupying the premises. The refund will be made to the SMSF within 3 to 6 months, and then the SMSF repays the GST loan to Thinktank. And so the second example is the second scenario is what we call a top-up loan. So the top-up loan allows certain borrowers the ability to borrow additional funds to purchase their desired property. As many of you will know, there is an opportunity cost when it comes to acquiring property. Currently, the maximum loan to value ratio for a full doc loan is 75%. This is where the borrower provides 2 years worth of financial statements. And in that case, the 75% maximum is on offer to borrowers who are able to provide 2 years worth of financials. And our top-up loan can go up to an additional 10%. So the maximum the borrower can borrow is 85% loan to value ratio. As I say, it's up to a maximum of 10, and I'll explain a bit later that our average loan to value ratio in the high yield trust sort of more teeters around the 75 to 80%. It doesn't usually get to 85 on average. So as at the 31st of August, the average loan to value ratio in the high yield trust was 76.85%. So you can see that's below the 85% maximum, but we do have the capacity to go up to 85 on a borrower by borrower basis. The kind of borrower we usually see looking for a top-up loan are full doc and mid-doc borrowers seeking to increase their loan to value ratio from 70 to 75% or 75% to 80. The top-up amount is quite small and is required to be paid back within 3 years. Thinktank encourages borrowers to pay this top-up amount within the 3 years by waiving all early prepayment fees. And the average term of a loan in the high yield trust is 14 months. So we are seeing borrowers taking advantage of that early prepayment and paying back that top-up loan a lot quicker than the absolute maximum that they can have that loan out in the market. The drawing from a most recent example, Thinktank was presented with a borrower who is a solicitor based in Ramsgate, which is a southern suburb of Sydney in the St George area. Solicitor is looking to purchase a 90 square metre office suite to run his business out of, so it'll be owner occupied. The borrower has been self-employed for 13 years. Purchase price of the property is $810,000, and the borrower is seeking to borrow $648,000. So that's an 80% loan to value ratio. And that will be split across 2 loans. So the loan number 1, 75% loan to value ratio, which is a borrowing of $607,500 at a rate of 5.69%. And then loan number 2, which is the additional top up 5%, is a $40,500 borrowing at a rate of 12%. This is a common loan scenario and borrower profile for Thinktank. The GST and top-up loans allow Thinktank to offer lending products with a point of difference, unlike many of the other major ADI lenders who don't have the same sort of product offerings to these kind of borrowers. And if in offering these additional lending products to borrowers, we're also able to offer investors such as yourselves an investment product that is traditionally only available to institutional investors. Thinktank maintains a conservative credit underwriting approach for all of our loans, which includes the GST and the top-up loans. GST and top-up loans are only lent to customers where Thinktank holds the first registered mortgage. We do not, under any circumstances, source second mortgages from third parties. So what that means is that Thinktank originates, underwrites, collects on all of the loans. We have complete control, we have complete oversight, and we do the credit underwriting for both the GST and the top-up loans, looking at can the borrower afford to service both of these loans. So by ensuring it's kept in-house, it provides some additional credit or lack of credit risk for investors there. Okay. So the next few slides are going to focus on the institutional and private investors side of things, how they derive income from Thinktank's portfolio of mortgages. As I mentioned earlier, Thinktank sources the majority of its funds from wholesale institutions. These are displayed in the A, B, and C notes in the diagram. In order for Thinktank to obtain this wholesale funding at an inexpensive cost, we raise funds from national and international institutional mezzanine investors and invest funds from our own balance sheet as capital protection or subordination. The funds of Thinktank are exposed to a loss first, and as such, they earn a higher return than the wholesale funding at the top of the debt stack, which is at risk of losing capital last. An important question all investors think about when investing with businesses like Thinktank is, what is the risk of a capital loss? This slide shows you our end of month August portfolio data across Thinktank's entire portfolio. Due to the size of our portfolio and the low costs of funds due to the cash rate environment that we currently find ourselves in, we're currently operating in a residual or surplus income amount per month, which is quite sizable. It is important to note that this number is after all investors in the debt capital stack or waterfall are paid. And this residual income is then used to pay Thinktank's rent, staff, business costs, and any capital shortfalls should there be a loss on a mortgage in that given month. Thinktank's average loan is quite conservative, as is our loan to value ratio. And as at the 31st of August, we have a portfolio of around 4,600 loans. And of that 4,600 loans, there's just 19 loans that are in arrears of 2 payments or more, or 60 days plus. If Thinktank had to take possession of any of these loans, and after the property was sold, there was a capital loss, Thinktank would comfortably be able to cover that capital loss from the residual income from that month and cumulative reserves. In the 15 years of operation, Thinktank's loan loss history is 0.06% and has been well below the industry average, including that of the major banks. The net residual income, after all Thinktank's costs are paid, are predominantly reinvested into new warehouse facilities and back into the business to continue to support the growth of the loan book and to provide protection for investors. And Thinktank currently has 5 revolving warehouse facilities providing in excess of 3 billion, well, 2.72 billion in funding capacity, 3 active CMBS transactions and 1 active RMBS transaction, which in total fund the loan book of 2.7 billion. Okay, these are probably diagrams you've been familiar with before. So just going to quickly finish on the income in the high yield trust. They're pooled mortgage funds. Investors are exposed to a diversified pool of loans in both trusts, as you can see here. And in both funds have a loss provision should there be any arrears or capital losses in a given month. And as you could see from the previous slides, if there are arrears or losses in the income and high yield trust in a given month, Thinktank's residual income is able to support both of those trusts to ensure that investors continue to get paid. And if there are any capital losses, then the residual income is more than enough to cover the handful of losses that we have experienced in our time. Okay, so since inception 2006, Thinktank's originated over 4 billion in lending and has had 2.3 million in principal losses, which is a very low loss rate. We have absorbed all of those capital losses within ordinary provisions and have not missed an interest payment to either institutional investors or private investors, such as yourselves. And this brings me to the end of my presentation. If you've got any questions, please feel free to get in touch on the platform. I'll be here all day, or you can get in touch with me at any later stage if you'd like to learn a little bit more about what we do. This is just a quick intro of me, although I haven't been able to do a lot of this of late. For those of you who are NRL fans, this will be aired after the Sydney Roosters Manly game. So if you are a Manly fan, please keep it kosher. And I hope that you guys have a lovely rest of the day and enjoy the presentation.
Today's SME and SMSF market relies on fit-for-purpose finance and investment solutions that genuinely meet the needs of both borrowers and investors. Thinktank Property Finance is a knowledgeable and established lender larger than most Australian credit unions and building societies. We offer financial solutions for both borrowers and investors. We provide conservative mortgage finance to credit-worthy borrowers, secured by mortgages over everyday Australian residential and commercial properties. Not unlike a bank, this allows Thinktank to pay interest monthly, so investors receive a reliable, no-fuss, zero-fee income stream. Thinktank offers investors a range of investment options to cater for a variety of risk, return, and capital protection preferences. Thinktank has been a trusted brand in Australian financial services since 2006. We have a proven track record of performance in investment and lending in the way we've supported our borrowers and prioritised the interests of our investors through both the good times and the challenging times. We are highly committed to delivering for our investors and maintaining the strong institutional relationships we've built over many years. If you have an interest in regular income investment alternatives, we may have a solution that works for you. Please come and talk to us. We look forward to discussing your needs.
Hi, Lauren. Thanks very much for that presentation. As usual, very informative about what's going on in the loan market or the gearing market for SMSFs. Now, we do have a few questions. I don't know whether or not Jenny can show these, but the first one is from you, Mish, and you may have already covered this, but what sort of interest rates would you charge for a commercial loan?
Yep, thanks for the question, and thanks for having me yet again. So the interest rates depend on the loan to value ratios. So if you're looking for a commercial loan outside of an SMSF for a full doc, which is looking at a 75% max LVR, you're looking at the high fours. If you're looking for a residential outside of an SMSF, then you're looking in the threes, probably the mid to high threes. And inside SMSF, you're probably looking at an additional % on both of those. But the interest rate really does come down to two things: the loan to value ratio and the amount of information that you can provide. And because we deal with predominantly small businesses or SMEs, as opposed to a PAYG, where we know after seeing 3 months worth of pay statements that's what they're receiving every month. We need years worth of financials, or a couple of years worth, or 1 year's worth of financials for self-employed and SME borrowers, which, depending on when you're looking at borrowing, you might only have 1 year's worth of financials. So the max we can offer is a 70% LVR, or we could do a 75%, but you might be looking at a higher interest rate there. So all of our rates are on our Thinktank website, all of our loan interest rates. But that was just a quick sort of, well, the best that you could be looking for is in a commercial would be looking at the high fours.
Lauren, this one's from Conrad. Why such a high interest rate of 12% versus the reduced risk of such a highly regulated SMSF?
Yep, thanks, Conrad. So the high interest rate of charging the borrowers 12% is because it's second registered mortgage. So the bank funded warehouse will get paid first, and then the high yield trust gets paid second. So, and then the borrower's equity is at the bottom of that. So it really does come down to the fact that we're asking investors, private investors, to participate in a second mortgage facility. And as we're probably all familiar with, that those subordinated or second mortgage facilities attract a higher interest rate there. Thinktank also takes a larger portion of the gap between what we pay investors and what we charge borrowers, and we keep that aside as a bit of a loss provision. And also at the moment, there aren't any other products out there, so we can be a little bit more aggressive in our pricing for that particular product, because at the moment we don't have any competition.
Here's one from Glenn. Ignoring the top-up loans, what is the scenario of the property market if the property market value decreases and the ratio goes above 75%?
Yep. Thanks, Glenn. So we don't do any regular revaluations, which is often quite a bugbear for these kind of borrowers when they deal with the major banks. For us, as long as our borrowers are making their repayments, we essentially leave them alone. Of course, if they stop making their payments, then we have to step in. But if we see that loan to value ratio go from 75 to 80, we're not going to adjust their mortgage or force them to repay, which has been known to happen in the banks. It will just mean that that particular borrower might struggle to refinance out of Thinktank and go to another lender. But essentially, as long as our borrowers are making their repayments, if an individual property makes that it loses 5% of value, we're not too concerned. Of course, across the whole board, we're starting to get a bit more concerned, but on an isolated one property basis, we won't really intervene unless the borrower starts missing payments. And even if it does go from 75% to 80, we've still got a fair chunk of equity in there if we need to sell the property. But yeah, as long as everyone's making their payments, we try and leave them alone and let them get on with it, really.
Conrad again, do you offer first mortgage?
Thanks, Conrad. Yes, we do. The first mortgages are funded via a bank funded Thinktank warehouse. So the non-bank sectors obtain the majority of their funding from domestic ADIs. And the reason is because we don't have term deposits, because we're not an ADI, we can't hold cash, we can't hold term deposits, which we know is how the banks generate a relatively decent percentage of their cash reserves to then lend back to us at exorbitant rates. We have to borrow it all. So we borrow it from at the moment, our major warehouses are funded by Commonwealth Bank, NAB, Westpac, and Deutsche Bank. ANZ don't really play in this space. So it's not that ANZ don't want to join the party. It's just not a space they particularly play in. So all of our first mortgages are funded via one of those bank funded warehouses. We also have the income trust, which I touched on briefly. It's a first mortgage fund, and that's for loans that Thinktank see as quality loans, but for a variety of reasons can't fit into a bank funded warehouse. But often those income trust loans can be securitized. So they may only sit on our balance sheet for 12 months, maybe 24 months at a maximum. So we offer first mortgages. The second mortgages is a really small part of our portfolio. So apologies if I misrepresented that. But all of the first mortgages are funded, bar about a very small percentage, are all funded via a bank funded warehouse.
Before we wrap it up, Lauren, just a really quick one from me. Obviously, we're all in lockdown here in New South Wales and Victoria as well. So COVID-19 and the way of doing things is very, very top of mind. Mm-hmm. And of course, last year we saw some loan repayment relief. How does that affect you guys?
So we were part of that loan payment relief, and when the lockdowns happened, the AOFM, which is the Treasury arm of the government, came out and said, we are going to support the non-banks and the institutional securitization market by providing liquidity. And if you need to borrow money, you can borrow it off us at the bank bill swap rate 30 days, which I believe you touched on early in the presentation, which Thinktank participated in. So we had at the worst from April last year till June, 25% of our loan book was requesting hardship. And that's because we had no idea what was going to happen, as we all experienced. That tapered down very, very quickly because each state, except for Victoria, rebounded from about July onwards. And we were able to repay back all of the money that we borrowed from the AOFM last October. So that provided us liquidity within our funding vehicles to ensure that we could continue lending, and it provided competition in the securitization market. And the securitization market works not too dissimilar to when you go to look at purchasing a property. If there's 10 people who all want to buy that property, that particular asset, then the price gets tightened. If there's one person wanting to buy it, you as the seller are in a bit of trouble. So the AOFM stepped in and said, okay, for everyone that wants to buy the A notes, we're going to make a bid of 95 basis points. If you want part of this asset, you're welcome to make a bid, but it has to be cheaper than 95 basis points. And by doing that, they ensured that one, the institutional securitization market remained viable, and two, that the non-bank sector, which is a huge part of our lending sector in Australia, remained afloat, and that we didn't have to force people to sell their properties, because we all know what would have happened if that was the case. So those programs are still in place if necessary. As we know, this time round, the government changed how they provided support to borrowers and to consumers and customers. And I won't go into which one was better and which one was worse, but what we're seeing at the moment is a really low percentage of hardship requests coming through, which is surprising to us. But whether people just hoarded cash last year because we weren't sure if this was going to end, or whether the government support is hitting some of the right pockets, or whether our borrowers just seem to escape lockdown, which is a very unlikely scenario because we have 4,600 of them. But the government support is there not only for individual consumers and borrowers, but also for lenders like Thinktank. And if we were in a scenario like we were last year, we will draw on that facility again. But that's basically how we managed last year, and how we were able to support our borrowers as well as our investors.
Okay, thanks for that, Lauren.
No
thanks
worries
for the session. Great information again. Of course, go to the Thinktank booth during the breaks, and if you didn't get to ask Lauren a question that you wanted to, please do. She'll be around all day, and no doubt she'll be only too pleased to have a discussion about the Thinktank offering with you. Now, it would be remiss of me not to mention that Thinktank are actually giving away a delegate bag or a goodie bag for people who visit their stand. So just go in there, make sure you type in SMSF TED in the how did you hear about us section, and that will all be taken care of. Now, one thing I was asked to mention is that Thinktank will record the best address to send that goodie bag out to you. So please don't forget to supply them with that information once you are there. So thanks again to Lauren. Great session.
That's it. Thank you, guys.